What if I told you that the stock market isn't designed to make you rich overnight? It's designed to test your patience, discipline, and emotions every single day. Every morning, millions of traders around the world open their charts believing they'll outsmart the market. They search for the perfect indicator, the secret strategy, or the next big stock that will change their lives forever. Yet, by the end of the year, most of them have either lost money or given back the profits they worked so hard to earn. Why? Because they were playing the wrong game. They thought the market was a puzzle to solve, when in reality it's a game of probabilities, psychology, and discipline. The greatest traders in history didn't win because they predicted every price movement. They won because they understood something that most people never do. Your biggest competitor isn't another trader, a hedge fund, or an algorithm. It's the voice inside your own head. It's the fear that makes you sell too early, the greed that convinces you to hold too long, and the hope that keeps you trapped in losing trades. The market has no emotions, but every participant does, and those emotions create opportunities for the few who learn to control them. In this journey, we'll explore the timeless principles that separate consistent winners from emotional gamblers. You'll discover how professionals think, how they manage risk, how they read market behavior, and why consistency always beats excitement. Stay with me until the very end, because once you understand the real rules of the market, you'll never look at trading the same way again. Welcome to Winning the Market Game, where success isn't about being lucky. It's about thinking differently. Every beginner enters the market believing success comes from finding the perfect strategy. They jump from one indicator to another, watch countless videos, join trading communities, and constantly search for a magical formula that never loses. But after enough time in the market, they discover an uncomfortable truth. No strategy wins all the time. Every successful trading system experiences losing trades. The difference between professionals and beginners is not the number of losses they experience. The difference is how they respond to those losses. Professionals accept them as a normal cost of doing business. Beginners treat every loss as a personal failure and often abandon perfectly good strategies after only a few setbacks. The market is one of the few places where being wrong is completely normal. Imagine a professional baseball player who reaches base only 3 out of every 10 attempts. In many leagues, that player is considered exceptional. Trading works in a surprisingly similar way. You don't need to win every trade to become consistently profitable. You simply need a system where your average winning trade is larger than your average losing trade, combined with the discipline to follow that system over hundreds of trades. Success comes from consistency, not perfection. The first rule of winning the market game is simple. Protect your capital at all costs. Every opportunity in the future depends on the money you still have today. A trader who loses half of their account must earn a 100% return just to recover. That is why experienced traders think about risk before reward. Before entering any trade, they already know where they will exit if the market proves them wrong. This decision is made calmly, before emotions become involved. Once the trade begins moving, the plan has already been written. Preparation replaces panic. Another lesson separates experienced traders from emotional ones. The market doesn't reward confidence. It rewards discipline. Confidence without discipline often leads to oversized positions, impulsive entries, and unnecessary risk. Discipline, on the other hand, keeps traders grounded even after a series of successful trades. It reminds them that every new position is independent of the last one. Yesterday's profit does not increase today's probability of success. Every trade must earn its place according to the same carefully defined rules. Perhaps the greatest challenge in trading is learning to think in probabilities rather than predictions. Every chart pattern, every support level, every breakout, and every technical signal represents a possibility, not a guarantee. Professional traders never ask, "Will this trade definitely work?" Instead, they ask, "Does this setup give me a favorable probability with acceptable risk?" That small change in perspective removes enormous emotional pressure. Trading stops becoming a guessing game and becomes a process of consistently making high-quality decisions under uncertainty. As we begin this journey through winning the market game, remember that long-term success belongs not to the trader who makes the most exciting trades, but to the one who consistently makes the smartest decisions. The market will always test your patience, challenge your confidence, and tempt you to abandon your plan. Those who learn to remain calm while others become emotional discover the greatest advantage of all, because in the end, winning the market game has never been about defeating the market. It has always been about mastering yourself first. The longer you spend in the market, the more you begin to realize that price is never moving randomly. Every candle on a chart represents a battle between buyers and sellers. Every breakout reflects increasing confidence. Every pullback reveals hesitation. Every strong trend tells the story of thousands of traders gradually agreeing on the direction of value. Charts are not simply collections of red and green candles. They are visual records of human psychology. Fear, greed, hope, confidence, uncertainty, and impatience leave their fingerprints on every market movement. Once you begin seeing charts through this lens, trading changes completely. Instead of trying to memorize endless indicators, you start learning to read the behavior behind the price. One of the greatest mistakes beginners make is believing they must always be trading. They sit in front of their screens for hours, convinced that every market movement is an opportunity waiting to be captured. But professional traders understand that patience is one of the most profitable strategies ever created. They know the market will always open tomorrow, next week, and next month. There is no prize for taking the most trades. The goal is to take the highest quality trades. Sometimes the best decision is to do absolutely nothing. Waiting for the right opportunity requires discipline because inactivity often feels uncomfortable. Yet, avoiding poor trades is just as important as finding good ones. Imagine a skilled hunter walking through a forest. He doesn't chase every sound he hears or every movement in the bushes. He waits. He observes. He understands that one carefully chosen opportunity is worth far more than 10 reckless attempts. Successful traders develop the same mindset. They allow the market to come to them instead of constantly chasing it. They know that forcing trades out of boredom, excitement, or fear of missing out usually leads to unnecessary losses. Another lesson that separates professionals from amateurs is their relationship with losses. Beginners often believe losses are signs that something is wrong with their strategy. They become frustrated after 2 or 3 losing trades and immediately begin searching for another system. In doing so, they never give any strategy enough time to prove its long-term effectiveness. Professionals understand that losses are simply part of the business. Even the best traders in the world experience losing streaks. What matters is not avoiding losses altogether, but ensuring that no single loss has the power to damage the account or destroy confidence. This is why position sizing becomes one of the most overlooked skills in trading. 2 traders may identify the exact same setup and enter at the same price, yet experience completely different outcomes because of the amount of risk they choose to take. One trader risks only a small percentage of the account, allowing them to think calmly and objectively. The other risks far too much, causing every small market movement to feel emotionally overwhelming. Once emotions begin controlling decisions, discipline quickly disappears. Position size influences psychology far more than most beginners realize. There is another emotional trap waiting for almost every trader: the desire to recover losses quickly. After a difficult trade, many people feel an intense urge to immediately earn the money back. They increase their position size, ignore their rules, and begin taking trades that never would have met their normal standards. This behavior, often called revenge trading, has ended countless trading careers. The market has no memory of your previous trade. It does not know you lost money 5 minutes ago, nor does it owe you an opportunity to recover. Every new trade must be evaluated independently according to your plan. Emotional recovery rarely leads to financial recovery. One of the most powerful habits a trader can develop is keeping a detailed trading journal. Every trade becomes a lesson rather than simply a profit or loss. The journal records why the trade was taken, whether it followed the trading plan, what emotions were present, and what could have been improved. After dozens or hundreds of trades, patterns begin to emerge. Perhaps profitable trades consistently occur during strong trending markets. Perhaps losses increase whenever impatience influences entries. These observations become invaluable because they reveal not only how the market behaves, but how you behave under different conditions. As experience grows, successful traders gradually stop focusing on making money and begin focusing on executing their process perfectly. This may sound strange at first, but it transforms everything. Money becomes a byproduct of disciplined execution rather than the primary objective. Every trading session becomes an opportunity to follow rules, manage risk, remain patient, and make thoughtful decisions regardless of the outcome. Ironically, the less emotionally attached traders become to individual profits, the more consistent those profits often become over time. Another important realization is that the market rewards flexibility, not stubbornness. Many beginners become emotionally attached to their predictions. Once they decide a stock should rise, they continue believing it even as overwhelming evidence proves otherwise. Professionals hold opinions lightly. They understand that the market is constantly providing new information. If price action contradicts their original idea, they adapt quickly without feeling embarrassed. Changing your mind in response to new evidence is not weakness. In trading, it is one of the greatest strengths you can possess. As we continue through winning the market game, remember that every trading day is another opportunity to strengthen habits that extend far beyond the stock market itself. Patience, discipline, emotional control, humility, and consistency improve not only trading performance, but nearly every important area of life. The greatest traders are not simply experts at reading charts. They are experts at managing themselves. And when self-mastery becomes stronger than emotion, the market begins looking less like an unpredictable battlefield and more like a place where careful preparation, disciplined execution, and long-term thinking quietly create extraordinary results. One of the most valuable lessons the market teaches is that consistency is far more powerful than intensity. Many beginners start their trading journey with incredible excitement. They spend entire weekends studying charts, watching videos late into the night, and placing trade after trade because they believe more activity will automatically produce better results. For a short time, that enthusiasm feels productive. But eventually, emotions take over. A few losses create frustration. A few wins create overconfidence. The routine becomes exhausting, and discipline begins to disappear. Professional traders approach the market differently. They understand that trading is not a sprint. It is a marathon that may last an entire lifetime. They don't need to double their account this month. They need to protect it well enough to still be trading 10 years from now. Imagine a farmer planting crops. He doesn't dig them up every morning to check whether they're growing. He prepares the soil carefully, plants quality seeds, waters them consistently, and allows time to do its work. Trading follows the same principle. Once a trade has been planned according to strategy, constantly watching every tick of price rarely improves the outcome. In fact, excessive monitoring often creates unnecessary emotional pressure. Every small movement begins feeling significant. tempting traders to interfere with positions that were originally well planned. Sometimes the greatest discipline is simply allowing your plan enough time to unfold. Another principle that separates successful traders is their ability to remain emotionally neutral, regardless of recent performance. Most beginners allow the last trade to influence the next one. A winning trade creates excitement and encourages unnecessary risk. A losing trade creates fear and hesitation, causing them to miss high-quality opportunities. Professionals understand that every trade exists independently. The market has no memory of yesterday's outcome. Today's setup deserves to be judged only by today's conditions, not by what happened during the previous session. There is also tremendous importance in learning when not to trade. Markets move through different phases. Sometimes they trend strongly in one direction. At other times, they move sideways with no clear purpose. Certain strategies perform exceptionally well during trending conditions, but struggle when prices become unpredictable. Successful traders recognize these changes and adapt accordingly. They understand that sitting on the sidelines during unfavorable conditions is not a sign of weakness. It is a professional decision. Protecting capital during difficult environments allows them to take full advantage of opportunities when conditions improve. One of the greatest dangers in trading is believing that more complexity automatically creates better results. Beginners often fill their charts with dozens of indicators until price itself becomes almost impossible to see. They search for confirmation from every available tool, hoping certainty will eventually appear. Yet, many experienced traders gradually move in the opposite direction. Their charts become cleaner. Their analysis becomes simpler. They learn that price itself contains an extraordinary amount of information. Trends, momentum, support, resistance, and volume often provide everything necessary to make thoughtful decisions. Simplicity does not mean lack of sophistication. It means removing unnecessary distractions so the most important information becomes easier to recognize. Discipline also means accepting that opportunities will always exist in the future. Fear of missing out has caused countless traders to enter poor positions simply because they believed this was their only chance. The market constantly creates the illusion of urgency. The stock begins rising rapidly. Social media fills with excitement, and suddenly it feels as though everyone else is making money except you. This emotional pressure encourages impulsive decisions. Professionals remain remarkably calm during these moments. They understand that missing one opportunity means very little because the market will create another. There will always be another trend, another breakout, another pullback, and another high-quality setup. Patience protects both capital and confidence. As experience grows, traders begin recognizing that every market cycle teaches valuable lessons. Bull markets reward confidence, but often expose overconfidence. Bear markets reward patience and careful risk management. Volatile markets demand flexibility, while quiet markets test discipline. No single environment lasts forever. The trader who survives learns how to adapt without abandoning fundamental principles. They understand that success comes not from predicting every market change, but from responding intelligently when those changes occur. Perhaps the greatest transformation happens when trading becomes less about money and more about mastery. Every trading session becomes an opportunity to improve emotional control, strengthen patience, refine decision-making, and develop consistency. Profits remain important, but they become the natural consequence of following a disciplined process, rather than the sole purpose of participating in the market. This shift creates remarkable confidence because it places success under your control. You cannot control what the market will do tomorrow, but you can control whether you follow your plan, respect your risk limits, remain patient, and continue learning from every experience. As our journey through winning the market game continues, remember that the market will always reward those who think differently from the crowd. While others chase excitement, you cultivate patience. While others seek certainty, you embrace probability. While others react emotionally, you respond with discipline. These differences may seem small on any single day, but over months and years, they create extraordinary results. In the end, the true victory is not simply building a profitable trading account. It is becoming the kind of person who can remain calm under pressure, think clearly during uncertainty, and make disciplined decisions regardless of what the market places in front of you. That mindset is the greatest edge any trader can ever possess.